Third, the virtual vision test still doesn't have FDA approval, which is one reason it's mostly not covered by vision insurance. Maybe that approval comes through and the stock gets a boost, but maybe it doesn't. Fourth, Warby Parker is what we call a public benefit corporation. That's a B Corp. These are companies that try to make a positive social or environmental impact. For example, Warby Parker's donated 8 million pairs of glasses to people in need since its inception. That's fabulous. But people come to the store for, they come to look, you watch Mad Money to try to make money in the stock market. So I've got to tell you, B Corps have a pretty spotty track record as publicly traded companies, even as I am a firm believer that companies overall that care about the environment will, over the long term, do better than those who don't. But the track record right now, not so great. Fifth problem, Warby Parker's doing a direct listing, and these deals often struggle, especially the higher profile ones. Hey, remember Coinbase? Even the ones that ultimately work out, like Spotify, Slack, Asana, saw some mixed performance before their stocks took off. But, and this is big about it, we got a very strong direct listing just today. It's called Amplitude. Had a reference price to 35, opened at 50, stock ultimately closed at just under 55. If Warby Parker gets a similar reception tomorrow, they maybe perform as well out of the gate because people just say, hey, well, Amplitude was good. Maybe we should buy this one. This still leaves us with the questions of valuation, though. Unfortunately, their latest round of private fundraising valued the company at $3 billion, which tells me this one could come in hot. In fact, after the close, we got the reference price for the deal. And it came in much higher than I expected, $40. That's got to be because of the Amplitude. That values the company more than $4.5 billion, 7 times next year's sales. And if it gets a similar reception to the ones that Amplitude received today, it could go higher still. Given that this is basically a consumer products retailer with a 25% growth rate, that kind of valuation does make me nervous. Can't really value it on the earnings, given that it's not yet profitable. Here's the bottom line. In a tough market where investors are starting to sour on new issues, I think you should steer clear of Warby Parker, unless it falls below that reference price and you can get it in the 30s. Otherwise, I recommend putting the shades on, being Jimmy Chill, and waiting for a pullback to a lower level.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.